John, it's great to see you. Thank you so much for being here.
Thanks, Julie.
So I was doing the math. I think that your year-end target of 70.50 would imply between a 3 and a 4% rally pretty much from these levels. What do you think is going to get us there? I mean, obviously we've seen consistent rallies throughout this year, but what's sort of the next catalyst to push us to that level?
You know, Julie, I'm looking at the screen and you have our year-end 26 target, which I think is so much more important because we only have about 7 or 8 weeks left in this calendar year. And obviously a little bit of noise can move things. But if we look towards the next, let's say 14 months, as opposed to the next 6 or 8 weeks, it's going to be earnings. The earnings have been incredibly powerful. The market is expecting another double-digit year, about 13 or 14% earnings growth. And even if those numbers come in lighter than that, you still should be able to deliver really healthy returns.
And it's been a little bit confounding, right? In the face of all of this sort of macro stuff and noise that we've been talking about, whether it be the shutdown or the tariffs or whatever has been thrown at this market, you look through that and you look at these earnings, and as you say, they've held up well. What is going on? Is that basically that this is all the tech and AI trade and that the earnings strength, a lot of it's coming from there?
I think, Julie, there's 2 ways of looking at this. If we look at it in terms of earnings growth, then you have a situation where tech companies are growing somewhere year over year, something like 27, 28%. You have like a 23 or 4% growth rate in financials. A lot of that is driven by some boosts in M&A activity and deal activity, and that's really strong. And that represents about half of the S&P overall. But then if you look at the rest of the market, traditional cyclical groups like industrials and discretionary and energy and staples, they're delivering roughly 2 to 4% growth. So you have part of the market that's growing mid-20s, and the other half of the market is growing at a really weak, a low single digits. But if you look at the health of earnings season, the way that we measure it, and if you think about institutional clients and the way that they would look at it, did companies beat expectations, for companies this quarter? And companies are beating by 9%. Now, it's typical that companies beat lowered estimates and they beat by 4% or 5%, but a 9% earnings surprise is an insanely strong number. And revenues, the top line, is beating by 2%. And typically that's much lower. So this is really healthy from a surprise perspective across basically every single sector, but the growth rates are really bifurcated.
So, and do you worry at all, because it sounds like you think that the growth part of it has fundamental underpinnings. Do you worry at all about this whole debate about speculation in this market and whether things have gotten a little bit too far in terms of valuations in some areas of the market?
I think that there's a mistake that investors make, that when the market goes up, they naturally assume that things are more expensive. If you look over the let's say the year to date, and you look at the broad suite of tech companies, they're up something in the ballpark of 26 or 27%. About 22% of that is earnings. So the amount that's coming from an increase in valuations is really small. And so I really think that we're not calibrating. The reason the overall market looks expensive is because the portion of the market in tech and high PE stocks is going up, not because the PEs of individual companies is getting higher. It's a mix issue where the market is becoming more growthy, more tech oriented, and therefore it has a higher PE, but not that the individual companies are problematic. If you look at these tech companies and I'm talking about, the larger names, the Nvidias and the Oracles and the, that whole basket of large cap tech companies, for the most part, their PE multiples are lower today than they were 2 years ago. And that is not the way that it's being portrayed in the media or in the general conversation.
So if you are looking at this bifurcated market, do you want to buy the whole S&P 500, or do you really want to overweight the groups that are doing better on an earnings basis?
I'm laughing at your question because when you're buying the market, you're kind
I mean,
of
you
are
are
buying
overweight. Okay.
a tech basket.
But like, do you
huge,
just buy the tech, for example?
There's a really good argument. If you said I'm going to buy, let's say, a growth index fund or a growth mutual fund or what have you, 15 years ago compared to buying the broad S&P, you would have done dramatically better. And if you look at, if you think about the idea of American exceptionalism, it's not everywhere. It really is in the tech suite and maybe some areas in healthcare or biotech. But if you look at the non-tech portion of the S&P and then you compare it to the rest of the world, it kind of looks relatively similar. And then you have this, 40% or 50% of the market that is just delivering. It's not that the prices in the stocks are going up. The companies are doing something really special. It's showing up in their revenues. It's showing up in their earnings. And that's the story. It's not speculation. And I think it's going to continue. I don't see any reason why in the next 3 to 12 months that's going to turn. And if you look at the numbers, the way they're coming in and who's beating estimates and how the market's responding, there's just every signal is that this is going to continue.
So John, really quickly then, if you don't see any reason why it's not going to continue, is there anything that could slow it down? What would be the roadblock? If you had to pick a risk, what would it be?
Oh, I mean, there's always lots of things. I mean, if we had and we'll see what happens with the tariff discussion in the Supreme Court, but economists broadly expected these tariff issues to have a big impact on the economy. And it's had virtually no impact, not virtually no, but very, very little. And it's possible that it is having an impact. It just takes an extra several quarters for it to play through. So you could have the economy turn weaker. I don't think that if it's a little bit weaker, that's going to affect how we implement AI across our entire economy and society. But if you did see the unemployment rate start to pick up, companies would change their spending behavior. I think you covered in your last segment, the employment situation is pretty tepid. It's really strange. We have a pretty good economy if you measure it the way that we do, if we're looking at markets. And then if you look at jobs are weaker. It's possible that we could have negative job growth once the government opens up and starts reporting these numbers again. And that could cause corporations to cut back on spending. Do I think that those are going to happen? No. Do I think it's a real risk? Absolutely. And we're tracking it.
Well, quick check on stock futures. We're a bit mixed at this point, pretty much trading flat. The Dow indicating a higher open, up just around 60 points. And the moves come as this week's tech sell-off has many wondering whether overvaluation concerns have finally hit a boiling point and if we're now seeing the end of a bull market that's been chugging higher since April. For a deeper dive, let's bring in Carol Schleif, BMO Private Wealth Chief Market Strategist. Carol, there's been a lot going on the past few weeks. A lot of talk of a market bubble, whether we've hit the peak in the bull market. How concerned should investors be with this latest sell-off? Because a lot of strategists have also been telling us that a pullback was coming sooner than later.
Right. Well, a pullback would be normal, especially when you look at the energy that's been deployed coming off of those April lows. So some sort of a pullback in here would be natural. It's important, though, and the one thing that the markets have done very well all year is they might freak out a little bit in the short run, but they keep pulling back to what those fundamental threads, the underlying fundamentals are. And the underlying fundamentals remain pretty solid overarchingly. And we've seen that with tech company earnings, with other company earnings that were coming into the season so far, with something like 2/3 of the S&P having reported. We're talking double-digit bottom line earnings growth, which is pretty amazing for this far in the cycle. And so a pullback would be normal. The underlying fundamentals remain there. And actually a pullback, I think, would be constructive in here because it allows markets to reset. They had kind of run ahead of things, as markets are wont to do.
So you're saying underlying fundamentals remain strong. How much can that offset the concentration risks within this market? Because we've seen the S&P hit 36 record highs, but just 6 stocks have driven half of those gains. So when you look at this pullback in relation to how concentrated this market is, does that indicate how much deeper this sell-off could potentially go?
Potentially, but you've also got, it's important to remember that those same companies are the ones driving the bulk of earnings and profitability. And you look at them in terms of, it's not like back in the late 90s. I know there's a lot of folks that want to conflate this with what happened in the late 90s, but it's a very different environment in terms of what's driven the earnings and driven the profitability are real companies generating real revenues out of real businesses. They're capacity constrained, which is part of why you've got the CapEx going on there. One of the things we are watching is how those are being funded, because you're seeing some of the funding happening in the debt markets now as opposed to cash flow. So yes, that concentration is there. But up until the past few weeks, we were seeing broadening out. There are other companies, other sectors that play into the build there, from in industrial manufacturing, materials. There are a number of different industries too that are generating double-digit earnings growth.
Carol, does that worry you that these Mag 7 players are now funding a lot of their debt or tapping into the bond market to fund a lot of these endeavors?
Yeah, it's definitely something worth watching, and it's worth unwinding, because in my own head, we're trying to figure out, do you get so intertwined? And I think we're very early in that process, because they had very strong balance sheets. They're trying to lever responsibly, if you will. They had almost underutilized balance sheets in a lot of cases. But the one thing we want to make sure is that we don't have a concentrated list of companies and funders that become so intertwined that they all become too big to fail. That's one of the things we're watching pretty carefully as well.
And given all the record highs that we've seen, sometimes folks tell us that, when you have some sort of a pullback and you have a little bit of volatility, it's good for investors because you can get in at cheaper prices. So are you advocating to buy the dip at this point, or would you wait on the sidelines a bit more?
I think it depends on client by client where they're at. We call it portfolio hygiene, and we've recommended continuing to rebalance through the year. It's also important to remember from a diversification standpoint globally that the U.S. markets, while they've done really well, have underperformed a lot of global markets. And so being globally diversified and continually rebalancing within that makes some sense. But for clients who have maybe year-end bonuses or early in the year bonuses, having a pullback in order to be able to deploy some of that cash makes sense. For other clients where they've got significant gains year to date and wanting to trim back and rebalance some of that into there, that makes some sense too. It's also great for those clients with appreciated securities to be able to do some year-end gifting to their favorite charities with those appreciated securities.
And finally, Carol, we have a K-shaped stock market, and it's coinciding with a K-shaped economy, with those higher income consumers driving a lot of the resilience that we've seen within the economy. How concerned are you of the link between the stock market gains to that higher income consumer, and how that could potentially bleed through to some of the economic growth that we've been enjoying over the past few quarters?
Yeah, I think that as well, the K-shaped consumer and the K-shaped companies in the economy is definitely worth watching, because you do, as your earlier segments talked about with the consumer companies, you're definitely seeing strain on the lower part of that K, and demographically as well. And so it bears watching, because it impacts a lot of the consumer companies. And you've seen it in some of the earnings reports where you've got a lot of frontline consumer companies that understand how fraught consumers are with the higher level of prices they're paying now versus 5 or 6 years ago. And you touched on this. Autos are expensive, homes are expensive, education, there's just a lot of things going in, making it tough for that lower side. And they're staying supremely value conscious, but they're also making choices in terms of, if they may not travel, as extensively, but they'll do staycations close to home. They may not spend up on certain things, but they'll divert someplace else. But the higher end consumer, as long as housing values in stock market, their spending tends to be much more tied to things like that, as opposed to employment concerns or things like that. And even with a pullback in here, we suspect that when you look at overall net income and values that top tier owns, it's grown substantially in the last few years, not just in the US, but globally as well.
This week in tech has been pretty brutal. What do you make of the latest sell-off? Is this a healthy correction, or maybe a sign of something a little bit more sinister?
Thanks. It's great to be here. We do see this primarily as a healthy correction. There certainly have been some areas of the market that have gotten extended, perhaps some valuations being more than could be supported by current growth estimates. So we see this as a healthy correction. We do think the market will find a bottom without spiraling downward here. But right now, the market is under some pressure, and this will probably continue in the short term.
Are you encouraging clients to buy the dips at this point?
Well, I think it pays to be patient. It depends how exposed clients are. We do think clients should be exposed and have a healthy exposure to the AI themes, the technology that is going to be the growth driver of the future. We don't think that trend is going away. We still think it's in the early innings and there's a lot more to go. But that said, over the course of days or weeks, you can get a lot of back and forth in the market. So I think it pays to be patient here, but also to look for opportunities.
So how do you play that then? If CapEx generation and really the returns and the ROI that we're going to see from AI is still years away, how do you stay invested in this space while not falling behind in other areas or pockets of the market that maybe are undervalued?
Yeah, well, one, we don't think it's years away. We think some areas are seeing earlier gains and some areas are probably going to take a bit longer. But we do think that those benefits, the productivity is going to be real. It's going to benefit the economy, going to benefit companies, and going to benefit consumers and individuals as well. So I think as a starting point, it's important to look at which companies are actually starting to see the earlier gains, where are margins expanding. Nothing in the market is really cheap now. I think that's the challenge that we have. It's hard to point to a sector or an area and say this is a safe haven because there's so much disruption in the economy, so many shifts going on, changes happening very fast. And when you have a highly valued market and you have those changes taking place, there aren't necessarily areas to hide out. I think the reality is you still want to lean into the primary growth trends, and that is AI and technology.
And another theme this week that emerged is crypto. Bitcoin heading for a decline of 9% this week, its worst week since March. And Inez, you've been following the crypto space very closely here. What's behind this drop and what are strategists saying could come ahead?
Yeah, Ali, I just got off the phone with the head of 10X Research. This is a research firm that's based out in Singapore, and they've made some pretty accurate calls over the last month, starting in the summertime, really. But basically, look, you've had these OGs, these long-term holders of Bitcoin that have been selling since the summertime, really, and you've seen sort of an acceleration of that selling over the last month or so. So that has weighed on the markets. You had the October 10th liquidation, which took out some very important technical levels. Some smaller investors were also liquidated there. And so what this firm is saying is that their base case is that the Bitcoin industry is now in a bear market, but they do not see this bear market lasting like in the one in 21. I mean, technically, it isn't a bear market because it's off 20% off its all-time high, which was reached about a month ago. But what they're saying is that if you break the 93,000 level, then you could see an air pocket and you could go further down. They're predicting perhaps into the 70s. At that point also keep in mind that fund managers that have been buying ETFs, and they may also be forced to sell as well, because why would you hold a long position or a substantial position in these Bitcoin ETFs if it's falling? So there are some risks in the near term. What could turn things around? I mean, there are catalysts that could turn things around. The Fed could decide to cut in December. You could have more of a regime change at the Fed going into next year. You could see the government reopen. So there are catalysts that could turn things around. But right now, we are seeing quite a bit of pressure in the crypto market in general.
Michael Burry, the hedge fund manager of the Big Short fame, has two new targets, Nvidia and Palantir. Burry, who rose to fame for his 2008 bet against the U.S. housing market, bought put options on the companies. That was revealed in a 13F, and that means he would profit from price declines. The disclosure comes just a few days after he posted cryptic social posts about market exuberance. Joining us now for more on investing in tech is Max Wasserman, Miramar Capital co-founder and senior portfolio manager. Max, it's good to see you. The Burry stuff caught our eye because, he even in his Twitter profile, X profile, he calls himself a Cassandra, right? Warning of things to come. Do you think that this is a warning that investors need to heed?
Well, thank you for having me, and I'm surprised at the reaction. It didn't take much to say anything about valuations being this lofty. So if he throws a little cold water on it, it's probably short term with the momentum trade right now. But yeah, these valuations are ridiculous. I mean, Palantir is up, 170% year to date, trading roughly around 250 times. A great company, great technology, but these tech stocks are valued at growth in perpetuity, that there's never going to be a hiccup. So for somebody to come along and throw a little cold water on it, I'm surprised more people are not doing it. But there's an old adage, you can go broke shorting a momentous market. So I'm not so sure how long this lasts.
Although I guess with puts, you're not putting quite as much as risk as if you're outright shorting a max. But so for normal investors who are looking at this question, what do they do about it? In other words, if you hold tech stocks, do you just keep holding them? Is it just a question of not adding at these levels?
It's a great question. We have an investment in a lot of these large cap dividend tech stocks, and they've grown very large. So we are scaling them back a little bit for a variety of reasons. One being the valuations, and we just don't want to be so concentrated in the tech market because people forget back in March and April this year, the NASDAQ was down 20%. So the market could take this momentum and shift to the negative, and people could get really hurt. So we wouldn't be piling into these investments. And depending on your tax situation, we would lighten up a little bit here. We definitely would take a little profit. I mean, again, we're not saying get out of them, but you got to manage the downside risk. The valuations here at 40, 50, 200 times. How much more do you expect to happen? And is it asymmetrical? I think there's more downside than upside in the near term, but the momentum is crazy right now.
Yeah, it does feel that way. And we've been talking to a lot of investors as well about diversification. And that means something a little bit different to everyone. And I think in your case, it means something a little bit different too. I'm curious about your strategy around sort of what you view as stocks that'll benefit as interest rates come down more.
Sure. I mean, we diversify. We have individual dividend growth stocks. So we have the tech, which represents about 27% of our portfolio right now. And then we're diversified in healthcare, consumer staples, energy, cyclicals. So we think as interest rates come down, the companies are going to benefit for that. Refinancing could help the housing market. Companies like Home Depot, which we have an investment. McDonald's, we think, as people have become more discriminatory in what they spend. But we like the defensive names. They're still growing, but not trading at these crazy multiples. We like healthcare, right? You're getting paid a nice dividend, 3 to 4% on average for some of these pharmaceuticals. And companies like AbbVie is a big investment for us. Waste Management's another good company. But we have a barbell strategy. We've seen this before. My partner and I have been around a while, from the white hair on my face, and we've seen when momentum changes. And when it changes, it gets ugly quickly. So we're telling people, have a little diversification outside these portfolios, because what's happening now, the investor says, why should I own anything outside of tech? Because everything else is going down. Basically, everybody's selling everything that's non-tech and piling into the AI trade and second derivatives of the AI trade. So they're creating really great risk reward outside of AI, and it's become such a momentum trade in AI. It's very hard to make money at this level.
Max, what are your sort of contenders for a catalyst to end the momentum?
I think somebody wakes up one day, not today, but wake up one day, say, I'm not going to spend 250 times earnings on a company. I don't think 55 times earnings on some of these great companies, good companies, but the rate of growth is being valued at perpetuity. So any hiccup in that is going to send these stocks into correction. And we're not talking a 5% correction. When the NASDAQ pulls back, it can drop 20, 30% in a heartbeat. We saw that in 22 when the NASDAQ was down about 34%. People forget. You saw that this summer, going into summer, when the NASDAQ was down over 20%. So what we're saying is any rate of growth, any change in that. But I would tell you a thing that really concerns us. OpenAI is a great company. We love it. We have investments in tech, the Googles, the Broadcoms, we have it. But there's a lot of circular financing taking place. All these companies are giving money to OpenAI, which turns around and counts the revenue back that they're going to get from these other companies. And OpenAI, is valued so highly, and it's not really generating as much revenue as people think. So if there's any hiccup in OpenAI's financing, that could cause a domino effect. We don't think it will, but we're just saying there's systemic risks out there that people are ignoring. And if there's a hiccup in financing in AI, Katie, bar the doors, because these stocks will drop like a heartbeat. So we're just saying identify risk, and for the individual investor, have exposure. But this is a good time to pare it back.
Right. Max, thank you so much. Good to see you.
Thank you so much. Have a great day.
We are coming up on this mark. As you look back over the past year, what has been the biggest surprise to you as someone actively involved in these markets?
Good morning, Brian. Thank you for having me on. To me, it's the market resiliency. I mean, it truly is the Teflon market. If someone had told us a year ago that the Trump administration was actually going to go through with all of these reciprocal tariffs, with threatening 100+% tariffs on China, all of these different trade metrics, and the stock market, while volatile earlier this year, just kept sailing away and is at new highs and surging, I think all of us would have been a little bit skeptical. But yet again, this market has shown it is Teflon. Nothing can stick to it, and clearly the bulls are still in control.
Tom, is there more going? So to your point, look, it has been Teflon. We have had tariffs are still in place. We have an ongoing government shutdown. Why? Why is there something underneath the surface of this market besides AI that keeps investors just so optimistic?
So I think it's employment. Obviously, AI is integral to where the S&P 500 is, especially, and that is the linchpin. But as I look beyond the surface, it's employment, right? As long as people have jobs and can get jobs, then they can really weather a lot of uncertainty, inflation, things like that. And the fact that the labor market has stayed so strong, I think, is sort of the unsung hero of this market rally.
Now, Inez, I hear everything Tom is saying, but look, I mean, a large part of this rally is based on AI optimism. Every time OpenAI comes out with another deal, that company sees the potential to raise even more money at a higher valuation. The companies it works with, their stock has tended to trade up.
Yeah, it's this market is being led by AI mostly, and you have analysts that have been talking about the markets going higher because of AI. Yes, you've had the Fed easing, but AI is really the driver here. I will say that over this past year, just looking at this past year, the stunning rally from the April lows has been so notable, where the administration basically shifted to, we are going to spend our way out of this issue, and we are going to invest in all the sort of touch points of energy, of AI, of industrial. I mean, if you look at every single sector that is up right now year to date, it is what the administration has also been looking at. So the chip sector, data centers, electricity generation, all of this is what has been leading this market. And of course, AI being the fundamental theme throughout all of this.
Tom, let me get back to you. Why can't this continue into next year? If tariffs aren't going to take down the market, if the shutdown's not going to take down the market, if higher valuations aren't going to take down the market, we have the Fed out there likely to cut rates a couple more times next year. What hits things here?
Yeah, so as we think about what goes wrong, I think that the simplest way to describe it, it's not that people were wrong to be worried about all these tariffs or policy uncertainty. It's that they expected it to be negative too soon. So the economy is still facing headwinds. The unemployment rate is rising. We are seeing economic metrics come in, but it's not reacting to tariffs and trade uncertainty as fast as everybody expected it to. But just because it doesn't do it as quickly, it doesn't mean it's not going to happen. And I think that, to me, as we look at 2026, I can start painting a case that the stock market is starting to make the economy look better than it really is, because AI is powering the S&P 500 higher, while the rest of these sectors, while not bad, we're starting to see little cracks. And I think that's a big thing to watch in 2026.
Brooke, let me bring you in here. To Tom's point, there are cracks emerging in this economy. I look at what Chipotle said. Starbucks results have started to improve, but still not blowing anyone's minds. We have the SNAP payments now missed. Now the retailer is going to report in a few weeks. I'm seeing cautious notes from Target in my box. I have a story on Yahoo Finance right now looking at Target stock trading at a 52-week low. So it's not all great out there economic-wise.
Brian, I think a key indicator on really how this low and middle income consumer who has been struggling, as all those reports hinted to, will become clear when McDonald's reports this week their latest quarterly earnings. We're certainly keeping a lookout on that, the return to U.S. same-store sales growth, the momentum that they have behind these key value plays, and really leaning into that idea that they can hold and gain back and maintain their value leadership in this sort of environment. And even what we heard once again within that 60 Minutes interview yesterday evening is President Trump really touting that overall grocery prices have gone down. Sure, beef is still bad, but we got egg prices down. These are the key issues that the everyday American, particularly those low and middle income Americans who really have been struggling in the backdrop, really rely on. He's touting that they've come down, but there are some key moments here that we're hearing within these reports, particularly for young people who aren't spending like they did even just last year, and importantly, a few years ago when that stimulus money was really flooding through this economy as well.
Tom, why do you think the market ignores stuff like this?
Because of AI, mostly, and because there's so much bullish momentum. I mean, you guys see this every day. I mean, OpenAI pledges to spend hundreds of billions of dollars with one of like 6 companies, and they just kind of rotate, saying they're going to spend hundreds of billions more, and they just keep going around. All this money has to be acquired, right? All this has to be sourced over the coming years. Yet the market trades as though it's a done deal. And so I think that this constant barrage of AI enthusiasm, optimism, is really helping. It's almost a distraction. And I'm not saying that it's not going to happen and AI isn't going to be the greatest thing in the world. But I think right now these headlines, which in reality don't actually mean much from a bottom line standpoint, are helping to keep investors focused on that excitement. And because of the government shutdown, we're not getting economic data to really provide a counter case. And so I think that it's just keeping people very optimistic.
And as outside of AI, if you go back and if we were having this conversation on November 5th and someone made a prediction that gold prices would be up at a record at the same time the stock market is at a record, it would be hard to believe. I can get cryptocurrency. You know, President Trump has been very friendly to the cryptocurrency industry, but gold has been the surprise move for me over the past 12 months.
Yeah, and it's up 50% year to date. It's still around the $4,000 level. Look, asset holders have done well in this economy. If you hold stocks, if you hold gold, if you hold metals, even if you hold Bitcoin since Trump was elected, asset holders are doing well. So when we talk about this K-shaped economy, yes, it's a K-shaped economy because the higher income ones are the ones that are doing most of the spending and are the ones that are sort of keeping everything afloat. If you listen to what Visa said last week, their high income spenders are the ones that are, driving everything forward. And we've seen this over and over, and we're seeing it when we talk about these earnings report and where the executives are basically pointing out where the spending is coming from and where it's not.
Tom, what are you telling your clients right now, and what questions are they asking you? Is it as simple as saying, hey guys, you've probably made bank this year off of all AI trades, just stay the course? I mean, there's no sign that trade is cracking yet.
So one thing I'm very surprised about by my subscriber base, which is predominantly advisors and investors, is people are very skeptical that this can continue. And it's just sort of a simple idea of the pandemic happens, stocks go up 25%. Interest rates go surging to multi-decade highs, stocks go up 25%. The Trump administration kicks the bucket over on global trade for the past 40 years, stocks go up 25%. And you're getting a lot of people starting to get this late 90s kind of vibe, obviously older investors. They are concerned that the market is essentially ignoring everything and just saying, well, it's just all going to work out great. And so far it has. But despite the very strong performance, it's almost that it's so strong, it's starting to make people nervous.
Do you see any positioning in the options market, Tom? I know you follow options. Is anybody betting against a short-term pullback at all? Anything you could see, any red flags?
No, actually sort of quite the opposite, right? It's sort of all systems are go. And if you look at it last week, I mean, we had these 3 kind of potential speed bumps. You had the U.S.-China trade, you had the big tech earnings, and then you had the Fed decision. the market sailed right through them. I get that Powell was more hawkish but nobody believes they're not going to, cut rates either in December or January. So that's where the concern is coming from. Everybody's on the same side of the trade, and Brian and everybody knows that when everyone's on the wrong side of the trade, it usually does pay to get a little cautious.
It's almost remarkable to me the extent to which there is still a pricing in that there will be a cut in December. Do you think it'll happen?
Yeah, I think it will happen. But listen, one thing I've learned about markets is you have to interpret what they are saying. There is a part of this committee that definitely would like to wait and evaluate the data. I think they can go. I think they should go. I think they can go quicker. But I respect the fact that inflation is running a little higher. I would argue, you're still, if you take 6 months core PCE, you're running at about 2.5%. Other metrics, you're running closer to 3%. My only view being that's not an infectious inflationary expectation dynamic that allows the Fed to move. In fact, in the market today, you can buy 5-year inflation break-evens at 2.5%. It's not like the market thinks inflation is a problem, such that I think the window is there. I have a stronger view that I think labor is a tricky thing from here, and I think there is significant displacement on labor that we're going to see over the next couple of years. Last week, being an embodiment of that when we heard from Amazon, UPS. Technology is changing the world. I mean, I was on a call with the CEO today, and we're talking about data center investment. When you go into data centers, you don't see a lot of people. You see a huge amount of CapEx. So it buoys the economy. You just don't see a lot of people in those facilities.
No, although you have to build them, right? You have to build them, you have to outfit them. That all requires people. But then when they're done, to your point, there's nobody there.
That's right. And by the way, it's not just AI that's creating this productivity. You talk about things around inventory management, logistics, client procurement, predictive maintenance. I mean, productivity is exploding everywhere. It means you see it in all the corporate earnings. Companies are doing well, the revenues are decent, cost of goods sold is coming down, their SG&A is coming down. You can operate with a lower cost threshold. That's why you're seeing M&A that's so high. I got to get bigger, I got to vertically integrate, I got to use data, I've got to use AI, and I don't need as much fixed infrastructure, including people.
So this so-called low hiring, low firing environment that we keep talking about, has that already changed? Are we just not seeing it in the data yet, but we have the anecdotal evidence?
So listen, there's no doubt that is the best characterization of where we are from a labor perspective today. My sense is companies are waiting, and you're seeing, I think today, I talked to CEOs who tell you, I'm comfortable with my labor force today. You saw Walmart freeze hiring. Let's stay where we are. Let's see if we can grow our business. And then you'll see some companies that proactively will reduce labor. I think, so if you take the last 4 months of data that we have gotten, and I don't think it's going to change much. The data we think is going to come is going to show the same thing. The last 4 months, if you strip out healthcare is not cyclical, it's not interest rate sensitive. We have negative job growth. I think that is something that is going to be persistent. Hopefully, the economy continues to be resilient, which I think it will. Actually, the economy's in good shape. I think the economy's in good shape, companies are in great shape. I think labor, not so much.
Okay, so here's the question then. So say the Fed cuts because they're concerned about the labor market. What does that do for the labor market? How does it help the labor market?
So there's a few things. By the way, you brought up the most salient issue. So by the way, what is the interest rate effect today? In inflation, you think about what's sticky inflation? Healthcare, insurance, education, pretty hard to get interest rates to help healthcare, insurance, education. Shelter is actually one that actually you can help. You bring the rate down, you help inflation.
But shelter's not the one that's the problem as much right now. As Austin just pointed out, it's the services inflation right now that's accelerating a little bit.
Those are the ones that are, but those are really, right. But shelter is coming down. By the way, something you're starting to see is the mortgage rate has come down to around 6%. All of a sudden, existing home sales are higher. You build more houses. You look at the earnings reports from the D.R. Hortons, the KB Homes, the Lennars. We're not building enough houses. Why? Because the home builders have to subsidize the mortgage rate. If you get that rate down, we'll get more housing. You'll bring down shelter. Listen, I think shelter is still the trickiest one. And what helps when you build more houses? Labor mobility. You lose your job in one state, I can move to another state. You create more velocity, and you can't AI building a house. Your point about data center.
Right.
If we can put a lot of people to work, there are so many reasons for doing it. Point being, listen, the interest rate tool today doesn't really affect CapEx because who's spending on CapEx? The big hyperscalers, et cetera. They fund through free cash flow.
And they also have a fiscal tailwind. I mean, not just AI, but in general, There's a fiscal tailwind for CapEx.
Totally. So that, I mean, it's not really, interest rate doesn't really affect CapEx like it used to in the 70s and 80s. Now, what is the interest rate affecting? Small business, 44% of the hiring in the United States. By the way, slowing, having a tough time. We need to help small business. Low income that borrows on their credit card, borrows student loan, borrows through other mechanisms. That is hurting. Housing is hurting. And by the way, the US government, 90% of what we finance in treasuries is 2 years and in. You keep the interest rate 100 basis points above where it should be, and that costs the country $100 billion per annum. So point being, the interest rate tool is not like it was in years ago when it was the calibrator, it was the modulator of growth in the economy. It affects the people that are getting hurt today, and it doesn't really do much for CapEx.
And so you think they will cut in December as a result of all of this reasoning?
I do.
We talked about a year ago at our big Invest conference, and then I quoted you for months afterwards because at that. But what's so fascinating to me is how much the world has changed since then. Because at that time we were talking a lot about the deficit and how concerned some corners of the market were, but. If you remember, you said it's not the shark closest to the boat. It is not the most immediate threat. And in fact, that threat has seemed to recede even more between now and then. Do you think that is, what do you think is the shark closest to the boat? And do you think it's okay that we're not as worried about the deficits right now?
So, I think I said it then, and I'll say it today. I think the amount of debt we have in the country is still a tail risk, but I think it is only a tail risk. We have to keep refinancing. By the way, the fact that 90% of our debt, 89% exactly, is 2 years in, we got to keep rolling immense amounts of debt. That is still the tail risk today. I haven't gone through too many crises in my life, from the housing crisis to emerging market crises, European crisis, financial crisis. It all centers around where the debt, where the vulnerabilities are, and that's the debt. Today it's at the US government. Listen, I think there are a lot of things happening that allow us, as long as the economy grows, and this is part of my thesis around, gosh, we got to run the economy with 5% nominal GDP. I think we'll hit it this year. I think there's a good chance we'll hit it next year. If you keep nominal GDP over the cost of the debt, meaning we get the cost of the debt down a bit, we keep nominal GDP, we'll actually de-lever the economy. So it is still the risk that's out there. Assuming the economy grows and we get the cost of the debt down, we'll be okay.
What is the biggest risk then?
So away from that, I'd say complacency. And when I see in markets, you start to see some things, there's a lot of money in the system. Part of why the equity market, I think, will keep going up. The technicals are extraordinary. People are willing to, to do things to generate return. That to me is out there. And then I don't see a lot. I feel good about the US economy. The only problem with the economy is it's bifurcated. It's the most bifurcated economy I've ever seen. You got working a couple of cylinders on CapEx, a couple of cylinders, high income spending, low income not. So anyway, I think the economy's okay. Geopolitics hopefully is stable. US-China relationship hopefully is stable. To me, it's just complacency and people putting money to work.
Well, and you said maybe going out the risk spectrum a little bit. You didn't say the word bubble, but I'll say the word bubble because it's been uttered by almost everybody lately. Is that... are we looking at that level of speculative behavior, do you think?
When I say no, the big companies today, the ROE these companies are throwing off, I actually went through the earnings that came out last week, and I was looking at the free cash flow that these companies are throwing off. It's like nothing I've ever seen. If you take free cash flow, just the companies, it was Google, Meta, Microsoft, and you look at the amount of, not just revenues, not just cash flow, free cash flow after you've spent on CapEx, they're creating major companies every quarter. And then the multiple, you look at they're trading at 20, 25, 26 times earnings. Now, I see a lot of deals, particularly in the private markets, that are no cash flow, no revenue for the next 2 or 3 years. And by the way, some are good business models. My guess is most of them will fall away, similar to what you saw in the actual bubble back in 2000, when you didn't have any cash flow, you certainly didn't have any revenues. So I do see some of that in the private markets, but generally in the public markets, I don't think it's overdone.
Are the private credit markets? Let's leave aside the sort of tricolor first brands situations that we saw. Elsewhere, do you think there are problems in private credit?
From a systemic point of view, no. We do a load of financing in real estate, commercial, resi, bilateral credit, bilateral finance. Generally not. I will say things that get auctioned off. Like whenever there's a big financing that gets auctioned off, or somebody wants to put their name on something that gets auctioned, like I look at the levels, sometimes it's through the public markets and think, why would you ever do that? There is some stuff, and they're around the edges in like financing software. What's going to happen with software and AI? There's some stuff around the edges that I think are tricky, but not a systemic, like we saw in prior decades.
All right, Rick, I got to end with this. You are reportedly on the short list to be the next Federal Reserve Chair. I know you can't say very much about it, so I would ask it this way. Is that a job that somebody can say no to if they are offered it?
I'd say being on a list is an unbelievable honor for me, and everybody, will evaluate it based on, their own particular thought process. Listen, it's a huge honor, and I'm going to go through my process, and I will say today, the investing side of what we're doing is, you were kind enough. We did this ETF called BINC. I mean, the amount's up to 14 billion, and it's pretty incredible. There's some fun things to do in the investment arena. So, anyway, I know it's not a great answer, but that's where I'm going to focus.
You're enjoying what you're doing right now, is what you're saying.
I am.
Okay. Good to know, Rick. We'll keep talking, I'm sure.
Thanks, Julie.
Thanks for coming in. Really appreciate it.
So you right here, Will, we are entering this final stretch of the year. You say balancing optimism with fatigue. Walk me through that. What is driving that tension?
Well, right now we're pushed almost 20% up on the year. As you mentioned, we're pulling back a pretty bad week right now. We had a 20% plus year in 2023, 20% year in 2024. So that to me is peak optimism, right? 3 back-to-back 20% years. And so it's natural for the markets to ebb and flow. You can't go up forever. And we're just, we're not looking for any type of downside catalyst here, but can things really get that much better to the upside from an optimism standpoint, which is, in my opinion, fatigue. So you can approach it in different ways with regards to like equity exposure, asset allocation and such, but I think we're at a crossroads here, which again, you see with the markets all over the place, even today, that there's a little bit of optimism and fatigue going on.
But if I am willing to bet, Will, listen, I think earnings are going to continue to expand.
Right.
Prices, should I just bet will continue to follow?
So that's one thing. If earnings season's actually being met. So we've had 3 quarters of 6 to 8, 9% earnings growth, and you're starting to see forward guidance not be met with optimism on prices going higher. We're seeing a pullback. So again, that again screams fatigue to me, which we're also have some seasonality at play too. So you're typically see November and December as positive months. So I think it's just a moment where the market's kind of battling back and forth with regards to the direction of where it's going to go.
Let me ask you this. One big theme this week, maybe it was the theme, was these concerns about the great AI trade, concerns about AI valuations. How as an investor do you think through that?
So you have to have AI exposure in your portfolios, in my opinion. It's the 4th of 9 innings. It's going to go higher. But again, the froth just needs to come off a little bit, in my opinion. These companies are fundamentally changing the way that the American economy is run. We're a tech service economy here in the States. You look abroad, you don't have the tech service economy. It's the old economy, and it's completely changing productivity. Companies are getting more productive. Margins are better than they've ever been. The downside to that is the consumer, right? We're seeing layoffs because of tech, and sentiment is being pretty bad. I think we had the 2nd lowest consumer sentiment reading ever today, which is not that great.
Nope, sure isn't. But look at a big theme, and you call this out. Stick with AI. You say the 2020s, well, you say it's the AI, data, and electrification decade. I guess my question is, if that's true, and you're a long-term investor and you're listening to that, where would you see the opportunities? I mean, broadly, would it be semis, would it be infrastructure?
Yeah, I think you have to stay broad here because, again, the concentration, it's kind of hard to actually stay broad with the Mag 7. We did some research where we boiled the S&P down into who has AI themes playing through to them. You see like Uber, Airbnb. So you can basically back into about half of the S&P 500 has some type of AI play built into it. It's one of the most popular questions we get from our advisors on behalf of clients is how much AI exposure do I have? And it's everywhere right now, and it's going to be everywhere going forward. And so you're naturally going to have that exposure. There's some cool ETFs out there that are interesting, like Volt, where you can get into electrification. They're basically energy plays. Which again is a downstream effect there. But again, just to balance everything here, I would say you have to watch like the data center, like private credit space, like that could be a concern. Like we're gonna have all these data centers. It kind of reminds me of going to a mall, like malls are kind of dying. So in 15 to 20 years, are we gonna just data centers everywhere? But who knows, that's down the road. So we have to be capital allocators right now. And that's obviously playing the prevalent themes that are at play.
Do you want to say U.S. focused? Do you see opportunities overseas?
I think, an equity investor needs to have some global diversification, especially with some of the macro forces at play right now. But, again, it's still, you have to have your U.S. exposure and then complement it overseas. Earnings are just now starting to pick up. Multiples are lower. So if you have earnings growth, multiple expansion, a more value-oriented economy overseas than here in the States, I think they balance each other nicely. And it's a hot topic. Nobody wanted international for 15 years because the S&P 500 outperformed it year over year over year. If you think back to the 2003, 2007 bull market, EFA, which is an international proxy, doubled up the S&P 500. And so if you would have been all US back then, you would have underperformed global diversification. So the degrees of global diversification depend upon client and advisor preference, but I think you should have some.
I got to ask about the government shutdown, only because just as we were sitting down here, we have these competing headlines. How, as an investor, as a strategist, you thinking through that?
So the government shutdown is super tricky. We're just talking about, the markets are down over 1% today, kind of trying to get back to even. Typically, we see the reverse on a Friday, the sell-off into the close because of bad news over the weekend. So I'm a little bit hopeful that this rally could lead to good news over the weekend, which would end the shutdown. But the shutdown is just another factor that's playing into consumer sentiment right now. You've got sticky inflation, all these layoffs. So consumers are seeing all this noise in the headlines and are starting to slow down their spending and expectations for where the markets may go, which is not a good thing.
I want to get you on this because we've been talking equities. Let me get your take on gold too. Obviously we had last month's sell-off, but you're still on pace here, Will. Best year since 1979. Where does it go from here?
Yeah, so gold's an interesting asset class. It's got some validity in some type of conservative portfolio. My recommendation right now with the gold being high in price, don't buy gold in your investment account. Go buy gold you can see shine, around your house, on your significant other or spouse. That, in my opinion, is probably a better way to play gold if we're talking after-tax money. Pre-tax money is different, right? Because you don't want to deal with the issues there. You should probably buy it in your portfolio if that's what you want there. But my recommendation is go buy gold, just the kind you can actually see shine.
Well, always great to see you, especially on set.
Yep, thank you.
Well, stocks rebounding from Tuesday's sell-off, fueled by better-than-expected private payrolls data. ADP reporting 42,000 jobs added in October. That was a marked turnaround from September's revised decline of 29,000. Still, with the surprisingly positive report, Fed Governor Stephen Miron points to the labor market as a bigger risk than inflation in his conversation with Yahoo Finance this morning.
I'm more sanguine on the inflation outlook than a lot of my colleagues are, in particular because I don't view tariffs as driving a material amount of inflation. I think policy is too restrictive and that we're too far above where neutral rates would be. And given the state of the labor market, I think that continuing to run policy that restrictive is to also run unnecessary risks.
Joining me now with his take on current Fed policy, we got Brad Conger, Hurdle Callahan Chief Investment Officer. Brad, great to see you, especially on set. Let's start there, because Stephen Miron talking to Yahoo Finance today, but I'm interested to get your take, Brad. You look ahead to that Fed meeting in December. Will they cut? Should they cut, Brad?
I think the data is moving in their way, and here's why. The announcements we've seen on layoffs from Starbucks, the big tech companies, Cisco, Microsoft recently, UPS, tens of thousands. I think that's going to flow through to numbers. Whether the government records those numbers or not will be the open question. But I think it's trending for a cut.
So it's trending for a cut, but we heard from Jay Powell, and you heard that was kind of the headline at that presser when he says, hey, December cut, no sure thing, far from it. Let's say you didn't get the cut, Brad. I'm curious, just hypothetically, you didn't get the cut, you got a pause. I'm interested what you think the market reaction would be to that.
It depends on the messaging that he gives around that pause. Is it a bullish pause? Is it a hawkish pause or not? I think Powell's comments last week were just, I need the market to reset to 50-50 and let the data guide them to the conclusion we're coming to because we're looking at the same data you are.
Let me switch to another big theme in the markets, and that's these new concerns, or at least new questions about AI valuations. And I'm curious how you're thinking through that.
So we're cautious, and I'll tell you why. It seems like This is a sector where there are a lot of unresolved questions about what business models are going to work, how much people are going to pay, where the compute is going to happen, and the valuations are suggesting that it's a clear path to trillions of dollars of revenue. I'm not saying that's not going to happen. I'm just saying that it's more likely that we get an air pocket at some point because of DeepSeek or because ChatGPT 6 doesn't have the same uplift in efficacy as we've seen. In other words, the models start to roll over in terms of effectiveness.
So you're broadly cautious, Brad. I'm just curious, how does that translate into investment implications? Like, does that mean, hey, I just want to avoid this AI trade, take those Mag 7 names, rip them out of my portfolio? What does it mean?
Well, we're underweight. What does that mean? So if the Mag 7 plus the AI-related names are 40% of the market, in our portfolios, they're more like 28, 27. So in our world, that is a relatively big bet against those. No one's going to zero these things out, right? That's crazy.
If you're underweight there, where do you want to be overweight? Where's the opportunity?
We like Europe, based on valuation.
You still like Europe?
Yes.
I've heard people pounding the table on Europe, still attractively valued.
It's the gap between the U.S. and the European valuations is extreme. And we're not saying that Europe merits a U.S. type valuation, but it's wider than normal by orders of magnitude. So if just a little bit goes right in Europe, and the earnings are coming out really nice. I mean, we had a great season in the U.S. Europe is equally having a great earnings season. And so I think Europe has stopped getting worse, and that's the good news.
Brad, I want to get you out on this. Supreme Court now, our esteemed justices, they're weighing the legality of those Trump tariffs. Interesting, you know, as our correspondent Ben Werschel was pointing out, even the conservative justices perhaps sounding skeptical. And I'm just curious, as an investor, how are you trying to think through that?
So it's almost like what I'd prefer is they're struck down. But what I think will happen is, because there's more chaos on the strike down side, which is Trump, the administration is going to try to replace them based on other theories of
other
trade.
levers and tools.
Exactly,
for sure.
What does that create? More uncertainty. What does uncertainty do? Corporates pull back on investment. So I almost, as an investor, I want stability. I'd rather have them in place. But I think the rational thing to do is to strike them down. I personally, when I read the emergency powers, it doesn't have the authorization.
All right, we'll see if our Supreme Court justices agree with you, Brad. We'll find out. Thank you, sir. Great having you.
Enjoyed it. Thanks.
And Michael, I mean, there is just so many unknowns in the backdrop there. I mentioned the uncertainty around Fed policy. Of course, there's a TBD of trade, the ongoing government shutdown. So what do you think? Can markets keep this party rolling and keep the momentum heading into year end?
Hi, Allie, and thanks for having me. Yeah, I think historically speaking, if you think about seasonality at this time of year, it usually is the winners that continue to win. And so I do think it's likely that the technology companies, the Magnificent Seven, are likely going to carry us through to the end of the year. That said, as you mentioned there, there are some things, to worry about. We've got the government, shut down. We're not getting economic data. So the Fed's kind of flying blind a little bit. Some of the private market data metrics out there are suggesting, that the labor force is weakening. And then, of course, you've got inflation creeping back up. So I think we're okay from now until the end of the year. But I wouldn't be surprised if we had a little bit of a growth scare, if you will, early in 2026 and potentially a rotation towards some of the defensive sectors.
Now, to that point, the debate over valuations, that's been a conversation that we've been continuously having. And we've seen these circular investments among some of those Mag 7 players. I mean, Amazon just today announced a $38 billion partnership with OpenAI. We have Oracle's $300 billion tie-up, Nvidia's ongoing dominance. Do you think we're entering bubble territory? Is this at all a warning sign for you? Or do you think the fundamentals justifies the valuations that we're seeing?
I think based on the earnings season that we've just had with most of the Magnificent Seven reporting last week, I think investors are starting to become more discerning. They're not rewarding higher CapEx spending from all the hyperscalers at the same rate. So, for example, Amazon, also Microsoft, and Google, they showed an acceleration in their cloud revenue growth. And so the market rewarded them with flat to higher stock prices in the case of Google and Amazon, because investors are seeing the returns there. But on the hand of meta platforms, Facebook, they increased their CapEx spending, but the ROI and the timeline for payback for Meta is a bit more dubious. I mean, yes, they're using AI to improve their ad targeting. And that's great in the near term, but it's unclear how much better that can get. And they're not a hyperscaler. They don't have a cloud business where they're seeing, a big uptick in revenue there.
And you did say you wouldn't be surprised if there is a growth scare heading into 2026 and that markets may be underappreciating a possible pullback. So when you talk about those defensive sectors, those defensive names, where are you pointing to there? Do you have specific stock picks?
I do. I think I want to focus really in the healthcare sector. In healthcare, you can kind of play defense, but also offense at the same time. So, a couple companies to highlight. One would be Veeva Systems. So this is a healthcare, a software provider for the healthcare sector. They're kind of like the Salesforce.com for the big pharma and biotech companies. They do customer relationship management. And in addition, to that, they also just had a big settlement with IQVIA, which is going to allow them to use IQVIA's data, and they can collaborate to build more products for their customers around data analytics. And then also that same settlement is going to allow them to sort of improve the rollout of their AI bots for customers. And so they first started rolling those out back in April, those AI agents. So we think the combination of those three things there is going to show some pretty big uplift for Veeva.
Yeah, the healthcare sector is only up around 5% year to date. The tech sector, though, is up around 30%. So that just goes to show some of the dispersion there among some of these sectors. But Michael Sayers, thanks so much. Appreciate your insights.
Thanks, Allie.
Well, stocks ending the day lower after Challenger reported the worst October for layoffs since 2003. Our next guest says to expect near-term economic weakness, which could lead to a pullback in stocks. Joining me now, we got Larry Adam, Raymond James Chief Investment Officer. Larry, it's good to see you. So maybe start right there, Larry. Curious to get your take on the economy. Where do you see this economy now and headed, at least in the near term?
Well, I think the quarter that we're in, fourth quarter, I think you are going to see some softness in the economy. First of all, we think that consumers are going to be challenged during this upcoming holiday shopping season. If you look at some of our surveys data that we put together, 88% of people say they're going to spend the same or less during this all-important shopping season. So I think that weighs on growth, particularly as people are worried about the increase in tariffs. And then I do think that the jobs market is weakening here, and everything we've seen this week pretty much shows that it's going to happen. It started out on Monday with ISM, and basically what you're seeing there is that the manufacturing renaissance in the United States is underway. But that's because businesses are really investing in capital and not necessarily labor. The ADP jobs that we saw, they showed that you're not really seeing any hiring being done by small businesses. And by the way, those numbers don't include the government. And I think you're going to see some significant reductions coming from the government because so far, all those people that signed up for early retirements or the buyouts, they haven't been included in the data yet because they were still in the books at the government until September 30th. And then today, you saw the largest number of layoffs, as you said, since over the last 22 years. So I think all of that points to some softness here, at least in the short term for this economy.
Is it just softness and a slowdown, Larry, or do you see risk of recession?
I don't see a risk of recession because once we get into next year, I think we get the tailwinds of that one big beautiful bill. I think that the tax cuts and the tax credits for the consumer will start to lead to a rebound in consumer spending. There's plenty of tax incentives in there for corporations to spend. And I do think the Fed continuing to cut interest rates will continue to provide, again, a tailwind for this economy. So I don't see a recession unfolding here over the near term at all.
All right, so better days ahead, but near term some economic weakness. If that's true, Larry, what does that mean for the stock market?
Well, first of all, I think we have to keep in mind that the pullback that we've only had has only been about 2.25%, right? It hasn't been that big. And it just extends the low volatility environment that we've been in. You know, let's keep in mind that we haven't seen more than a 3% pullback going all the way back to those the mid-April time period. That's the second longest streak without a decline of more than 3% that we've seen since 2000, right? So I think it's really time to see a pullback in the market. And we're looking for anywhere from a 5 to 10% pullback. And that's not really out of the ordinary because usually you get 3 to 4 of them per year. And that'll take us between the 100-day and the 200-day moving average. And I just think that would be a healthy digestion of the significant rally that we've had over the last 6 months.
So let's say, Larry, you did get that pullback, 5, 10%. I'm curious how you think investors would react to that, how they would respond. You think they move in and buy that dip?
I do think, and I think you want to be in the areas that have the best growth. And that points me to 3 sectors in particular. That would be technology, industrials, and healthcare. And I think if we do have a pullback, you're likely going to see a lot of those mega cap tech stocks potentially being the leaders to the downside, right? They've had the higher beta on the upside, which means they're probably going to have the higher beta to the downside. And I do think we're at that moment of truth. It's very similar to what we saw during the dot-com age, where people were questioning about the sustainability of growth in those stocks. I think that we're going to continue to see momentum build going forward. Those stocks have, outsized margins. They're going to continue to lead the growth, earnings growth in this market. And I think the investment's going to be there to continue to lead to, again, sustained, viable earnings growth in that particular sector. So those are the 3 sectors that I would continue really to focus on going forward.
That's what you like. What would you avoid, Larry?
Yeah, I'm a little bit more cautious on the consumer. As I mentioned, particularly over the upcoming, couple of months here, I think the consumer is going to be stretched. I think as those tariffs do go into effect, margins at many of those companies are going to be strained. So I would pretty much avoid a lot of the consumer part of the market. One thing I would mention, when you just look at the most recent earnings season that we've come through, 90% of the earnings growth came from 2 sectors, and that's technology and financials, right? So I think you want to continue to be where the momentum has been and not necessarily try and find those areas because they really haven't had the earnings to really support the continued upward momentum.
Final question, Larry. I'm just curious, that AI investment cycle you mentioned there, how important is that, Larry, to your more optimistic call for the economy next year?
Oh, it's a big part of it, right? I mean, it's the incentives are out there from the tax bill for these companies to continue to invest. And I think that's going to continue to drive it, not only from a physical economic perspective, meaning the building and the amount of money being spent on chips and data, but also on the productivity side, right? You're going to continue to see increased productivity coming from a large section of this economy, and that will help drive growth as well. So it's really dual-based.